Hey everyone, and welcome back to the channel. Today, we re-diving into a question that puzzles a lot of new and even experienced investors: index funds versus ETFs. Which one is actually better for you? We're going to break it all down in this two-part series. Let's start with the basics in part one. First up, what exactly is an index fund? Imagine you want to invest in the entire U.S. stock market, or at least a big chunk of it. An index fund lets you do just that. It's a type of mutual fund that holds all the stocks in a specific market index, like the S&P 500. The goal isn't to beat the market, it's to be the market. You're essentially buying a small piece of hundreds of top companies all at once. It's a classic, simple way to get broad market exposure and diversify your portfolio instantly. Think of it as a pre-packaged basket of stocks that mirrors a specific segment of the market. You buy and sell these funds directly from the fund company, and the price is set just once a day after the market closes. So what about ETFs, or exchange-traded funds? Well, they're a lot like index funds. In fact, many ETFs are also index funds because they track a market index, like the S&P 500. The big difference is in how they're traded. The E in ETF stands for exchange, and that's the key. ETFs trade on a stock exchange throughout the day, just like individual stocks. This means their prices fluctuate constantly while the market is open. You can buy or sell them at any time, giving you a lot more flexibility. So, while an index fund and an ETF might hold the exact same stocks, the way you interact with them is fundamentally different. Now let's talk about one of the most important factors for any investor: costs. When you invest, you'll encounter something called an expense ratio. This is the annual fee you pay to the fund company for managing the fund. Historically, traditional index funds had slightly higher expense ratios than ETFs. However, the competition has become so fierce that this gap has almost completely disappeared. Today, you can find both index funds and ETFs with incredibly low expense ratios, sometimes just a few hundredths of a percent. For example, some S&P 500 index funds and ETFs both have expense ratios as low as 0.03%. So, while it used to be a clear win for ETFs, nowadays, the cost difference is often negligible. The bigger cost difference might come from trading fees. Since you buy ETFs through a brokerage, you might have to pay a commission, though many brokers now offer commission-free trading on a huge list of ETFs. This brings us to trading flexibility. This is where ETFs really shine. As we mentioned, ETFs trade like stocks. You can buy or sell them anytime the market is open. This means you can react to market news instantly. See a dip you want to buy into? You can do it right away. You can also use more advanced trading strategies like limit orders, which let you set a specific price you want to buy or sell at, or stop-loss orders to protect your downside. With traditional index funds, you're stuck with that end-of-day price. You place your order during the day, but you won't know the exact price you paid until after the market closes. For long-term, buy-and-hold investors, this might not matter at all. But for those who want more control and the ability to trade intraday, ETFs offer a clear advantage. Finally, let's touch on tax efficiency. This one can get a bit complex, but it's a huge benefit of ETFs. When investors sell their shares in a traditional index fund, the fund manager might have to sell some of the underlying stocks to raise cash to pay them out. This can create capital gains, which are then distributed to all the remaining shareholders in the fund, creating a potential tax bill for you, even if you didn't sell any of your shares. ETFs have a unique creation and redemption process that avoids this. When investors sell their ETF shares, they're typically just selling them to another investor on the stock exchange. The fund itself isn't directly involved. This structure makes ETFs generally more tax efficient, meaning you're less likely to get hit with an unexpected capital gains distribution. Over the long term, this can make a significant difference in your total returns. So, we've covered the basics: costs, trading, and taxes. In part 2, we'll get into which one might be the right choice for your specific goals and wrap it all up. Make sure you're subscribed so you don't miss it. Thanks for watching, and I'll see you in the next video.